Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. The macro, micro, macro loop, market divergence, AI debt, and semis. This video presents a direct informational narration of the source document. Today, we're diving into the extreme market behavior unfolding right now. We'll be navigating a fascinating loop, starting from broad macro trends, zooming down into micro corporate realities, and pulling back out to macro market catalysts. Let's get into it. Here's our roadmap for this explainer. First, we'll look at the market's extreme divergence. Then we'll pivot to a micro case study on Oracle's AI-tied debt gamble, check out the history of semiconductor pullbacks, discuss why semis drive the broader market, and wrap up with upcoming technical triggers. All right, let's start with Section 1, the market's extreme divergence. The stock market is showing some truly bizarre behavior underneath the hood right now. We're in a situation where the broader index, like the S&P 500, actually appears to be rising, but the vast majority of individual constituent stocks are falling. This creates a really uncomfortable environment because the index performance completely masks the reality of individual portfolios. So you might see the index up, but your actual account is down, or vice versa. To really grasp the severity of this, take a look at the number 53. That is exactly how many times this specific breadth divergence has happened this year alone. And why does that matter? Because 52 was the absolute extreme peak recorded back during the dot-com bubble in the year 2000. We have officially surpassed those levels. To put all of this into perspective, the previous all-time highs for this divergence were 60 occurrences in 2024 and 58 in 2025. Sitting at 53 right now, and keeping in mind that this data is just from July, the market is on a blistering pace to completely shatter that all-time record. Moving on to Section 2, Oracle's AI debt gamble. Let's pivot and see how this plays out on a micro level. Oracle recently saw its stock drop into the $120 range. At the very center of this is a massive $300 billion 5-year data center contract with OpenAI that kicks off in 2027. To actually fulfill this, Oracle has taken on a significant amount of debt. We know this because Oracle's credit default swaps, or CDS, are priced extremely high right now, implying the market views this debt as highly risky. Oracle's financial health is now deeply structurally bound to this one single client. And obviously, if Oracle wants to get paid, OpenAI needs the cash to pay them, which is roughly $60 billion a year. Look at these projections. OpenAI's revenue is expected to grow from $3.7 billion in 2024 to $13 billion in 2025, reaching up to $30 billion by 2026 and hitting as high as $62 billion in 2027. They desperately need this exponential growth just to afford their upcoming bills. Furthermore, OpenAI's IPO plans have likely shifted out to 2027. While their core target is a $1 trillion valuation, the current market estimate is hovering somewhere between $800 billion and $900 billion. Ultimately, Oracle's fate in this entire gamble is completely dependent on OpenAI hitting these massive financial targets in a fiercely competitive AI landscape. It's pretty simple. If OpenAI succeeds, Oracle wins. If OpenAI struggles, Oracle is left holding the bag. Now, Section 3, Semiconductor Pullback History. Let's transition over to the engine room of the whole market, semiconductors. The sector recently saw a steep 20% decline, dropping from a high of 655 down to 498. But to contextualize that, if we look back since 2011, there have been 15 instances where the sector dropped more than 20%. Out of those, 5 drops exceeded 30%, and the absolute worst drop recorded was 40%. So while jarring, a 20% pullback is historically not unprecedented for this volatile sector. But what usually happens after a 20% drop? According to historical data from JP Morgan, the average return for the sector after 20 days is actually a positive 8%. Push that time frame out to 60 days, and the average return climbs to a positive 11%. Which brings us to Section 4, Semis Drive the Market. You might be wondering why we're focusing so heavily on semis right now. Well, it's because they are the absolute linchpin for the entire market, currently accounting for over 20% of global trading volume. Looking ahead to the second quarter of 2026, semiconductors alone are expected to contribute an incredible 48% of the S&P 500's total earnings per share growth, almost half. However, we have to note that consensus earnings expectations for semiconductors have actually started to curve downward slightly from their recent extreme peak. While this downward revision is currently minor, it presents a very real risk. If semiconductor earnings expectations continue to trend down instead of up, it inherently means the broader S&P 500's earnings expectations will get pulled down right along with them. Finally, Section 5, Upcoming Catalysts and Triggers. For the immediate future, we're watching some very specific quantitative and technical levels. Semiconductors face a heavy resistance zone between 550 and 580. That's a pressure point where traders might trim positions. For short sellers, stop-loss levels are sitting at 584 and 615. Over on the broader index side, algorithmic CTA systems have sell triggers just beneath current market levels. Those start at 74.40, with much deeper sell-offs waiting at 71.75 and 64.45. Ultimately, whether these levels break up or down rests heavily on upcoming earnings from tech giants like Google and Tesla. The key metric everyone is watching is their capital expenditure, or CapEx. If they announce massive upward revisions in CapEx, it could push semiconductor valuations higher. But if they signal a slowdown, the market may struggle. So the question we are left with is this: will big tech's actual spending justify these massive market valuations?